Good afternoon, folks, and welcome to our Black Monday update for Tuesday, February 6, 2018. This past Friday was Groundhog Day, and apparently, jolted by the sight of a shadow, the little critter promptly panicked into selling his entire portfolio. This caused a ripple effect in the market, resulting in a drop of nearly 1,600 points at one point on Monday. The result is that the Dow erased its gains for the year. And for those of you who have seen the movie Groundhog Day, this stock reset can have you feeling a little bit like Bill Murray waking up to the music of Sonny and Cher. But before you start making toast in the bathtub, let's take a look at what happened, where we are, and whether or not this means we have 6 more weeks of winter. As I mentioned, global stock market turned sour Monday as the Dow Jones Industrial Average posted its largest ever single-point decline in the major index, and the U.S. and Europe and Asia also gave up their gains for the year. For the record, the Dow closed down 1,175.21 points, or 4.6%, which is the largest one-day percentage decline since August of 2011. Combined with steep falls on Friday, the index has lost 7% in just 2 days. Monday's selling was broad-based, with all 11 sectors in the S&P 500 posting declines. The Dow finished down 1.5% for the year and off 8.5% from its January 26th high. Tuesday's trading continued the volatility. The Dow fell as much as 567 points, briefly crossing the 10% mark that signals a correction, before quickly stabilizing and climbing to settle at 568 points to the positive. The move puts the Dow Industrials on course to notch one of the single largest intraday swings ever. Now, while there was no obvious catalyst for the stock sell-off, there are contributing factors. One is the perception of high valuation for equities. As we mentioned in our recent State of the Market, current valuations are at 18.2 times earnings, which is higher than the 25-year average PE of 16 times. Another is the impact of investors betting heavily against swings in the U.S. stock market. Selling short futures on the Chicago Board of Exchange Volatility Index, or VIX, has become a fashionable trade due to the recent market stability. A third is the result of computer algorithms that buy and sell stocks automatically, which tend to amplify market optimism when stocks are booming, but also make matters worse in a correction. But much of the volatility seems to be in response to a jump in bond yields. From September until the start of last week, almost all the rise in bond yields was due to a reassessment of what the Federal Reserve would do over the next decade. Bond yields went up generally as a response to growth inflation, which is good for profits, and as a result, good for stocks. As we mentioned in the State of the Market, as long as we have inflation at reasonable levels, a rise in rates wasn't bad news. Last week was different. Bond yields kept going up, but not on the expectation of future interest rate hikes. Instead, it was because of uncertainty about the levels of inflation, and so the market demanded higher premiums for this uncertainty. Higher inflation means higher borrowing costs, which cuts into profits. It means future profits are worth less on a discounted cash flow basis. And it means bonds are starting to look more attractive as investments. So what does all this mean? More winter for the stock market? That may depend on the answers we receive to a few questions. First, will the new corporate tax cuts encourage companies to spend on improving production? Or will they return cash to shareholders through dividends and share buybacks? Now, while an increasing dividend or share repurchase can have an ameliorating short-term effect, we'd prefer an increase in productivity to help justify higher valuations. Second, are investors overconfident about the outlook for inflation? As we discussed in the State of the Market, when rates are below 5%, equities tend to grow with rate increases. But when rates are above 5%, equities tend to decrease in response to rate increases. So low inflation means good news for the market, but a spike could result in more volatility. We will continue to monitor these and many other economic details as the year progresses. That's all we have time for right here. If you have any questions, and I'm sure you do, about your investments, please give us a call. Once again, this is Steve Memory with Iconic Wealth Management, signing off for the Black Monday edition of our Educational Economic Updates. Please remember that nothing we talk about here is a recommendation. If you'd like to discuss your personal financial situation, please give us a call at 703-891-9518. We'd be happy to talk with you.